So I'm here again with Lord Lee, the private investor evangelist. Last time we talked about Yummi Yoghurt, a first taste of stock market investment, so do make sure you've seen that if you haven't already. Lord Lee, a complete pleasure to be back with you again. You've lived through more stock market cycles than most of us. What have you learnt from each of them? And have you taken a huge hit? And how long did it take to rebuild your capital? What can we learn from them?
I consider myself very fortunate in having gone through some major loss periods, some major bear markets, and indeed, when we had the banking crisis in 2008, I said to a number of young stockbrokers who I used to talk to, that how lucky they were to have been advising, been investing, been involved in the stock market at so early a stage in their career when something's gone wrong, because it's important to actually recognise that there can be major periods when, for whatever reason, the stock market plunges. And I go back, I remember in the 1970s when we had what was termed the secondary banking crisis, when there were rumours about whether NatWest Bank would survive, and when so-called blue chip stocks, big cap stocks, were yielding dividend yield of sort of 20%. No one was buying, absolutely no one was buying, and the stock market fell right down. People were not buying at all. When you've been through that period, as I went through very early on, you realise it can happen again. You can't necessarily foresee, but it can happen. And the important thing is to keep your nerve, and provided, and I come back to the point that you mustn't borrow to invest in the stock market, provided you've only invested your own money and you don't need that money in the short term, you can afford to be patient and wait. And indeed, if you look back at these periods, they have presented very major buying opportunities. So when we had the banking crisis of 2008, for example, and prices plummeted, there were some excellent businesses that were on double-figure dividend yields, and they were, in my view, tremendous buying opportunities. And so I was buying at that time, and we've seen with some of them, 4, 5, 6 times appreciation from those low points. So there is a real opportunity, because you at the end of the day, you have to believe that Western economies will survive and grow. Because if you don't, and you believe that Armageddon is coming, then what do you do? I mean, do you hide under the bed with a couple of bars of gold and a crate of whiskey and just wait for the world to blow up or disappear? You have to take an optimistic view, it seems to me, long term, and therefore stay aboard.
But in 2008, how much was your portfolio down by?
I would have thought probably in that year I could well have lost, maybe 20, 25%, something like that.
Which is psychologically challenging.
But on the other hand, over the years that it had grown, the dividend income was still coming in. I had very few companies that even during that period actually cut their dividends. So one had that. And at the end of the day, I'd also kept certain cash back from a liquidity point of view.
And you always do that. So when the market corrects, you've always got cash on the sidelines that you can take advantage.
Yes. I've always tried to do that. And because within the ISA, because I've always reinvested in the dividends, there is a flow of income coming in, which gives me that opportunity to buy and add to. And the other point is that over the years, I've been on the receiving end probably of over 50 takeovers. Now, you can argue from a wider economic point of view that it's a pity that some very good smaller companies are taken over, and in many ways one would like to see them continue as separate companies and grow. But nevertheless, larger companies taking over smaller companies, is the way of the world. So I've been on the receiving end of over 50 takeovers, and most of them, of course, bring with them, with the takeovers, a premium to the then prevailing prices. So in the short term, you're doing quite nicely. But you never know when those takeovers are going to come. So it's a bit like the old joke, really. You ain't going to win the lottery unless you actually buy a lottery ticket. So unless you're aboard, unless you're invested in companies, you're not going to be in the receiving end of those takeovers. So I've tended over the years to stay put with good companies through those difficult periods, and I think long term have benefited when the economy has recovered, and then in some cases takeovers have come along as well. And I've never taken an extreme position, like, say, selling everything, as it were, as some people do, or going 40% into cash, because if you go into cash, what do you do then? You're sitting on a pile of cash. From my experience and from talking to people, you're then worrying all the time, when should I go back into the stock market? What should I go back into, as it were? And it actually provides more mental pressure and anguish than I think you do if you just stay aboard and work on the expectation that things will recover in time.
So beyond the dividend income, how much do you tend to hold in cash on the sidelines to take opportunities when they happen?
It's very difficult to say. And I suppose, to be absolutely honest, I don't keep too much cash now on the sidelines, because the dividend flow within the ISA is, as we referred to before, is now really very significant, and therefore that money is coming in and available to reinvest all the time. So in my case, because my portfolios have been relatively successful over the years, I don't need to quite have the reserves that other people might have. And also, when you get to my sort of age, by and large, you've paid off any mortgages or any borrowings, as it were, and one is set up reasonably conservatively.
And many have the belief at the moment that we're towards the end of a cycle. We've got an inverted yield curve and all of those sort of things. Does that mean that you position yourself for a recession, or does it not change your cash position?
It doesn't change broadly doesn't change my position at all. I believe it's about investing in good companies and staying with them, and working on the expectation and the belief, as in the past, that they will and have delivered. And so I don't get too worked up about particular cycles or bull markets or bear markets, as it were. I've seen many bull markets, many bear markets, and as we mentioned before, the serious crises of the 1970s and the banking crash of 2000 and financial crash of 2008. All my experiences told me, sort of stay put, go through the storm, and you will come out on the other side.
So most of our learning comes from our mistakes. So what mistakes have you learned the most from? Probably.
I suppose the biggest mistake overall is looking back, selling too many good companies too soon, taking profits myself, as I did in the early years.
Is that where the patience comes from?
And so you do learn. And I've sold some holdings. I mean, I remember, for example, let me give you one example. I invested years and years ago in a company in East Anglia called Wire and Plastic Products, small company manufacturing supermarket trolleys and animal cages for animal experimentation. Small business, capitalised at, I think, probably less than £1 million, to answer one of your earlier questions. And I bought some shares in it. And a few months later, all of a sudden, a certain Martin Sorrell, who I'd never heard of, turns up and buys 29% of it, or something similar, and the shares immediately treble. Now, I had no idea who Martin Sorrell was. I saw that I'd trebled my money, excellent. So I sold out and paid the tax, paid the capital gains tax then, and moved on and reinvested. Now, had I stayed aboard, that wire and plastics products, you've obviously guessed, became WPP with enormous growth over the years. And had I stayed put, I would have done very well. Obviously, in more recent years, WPP have had its problems, but nevertheless, one has seen very, very substantial growth. And there have been a number of other instances where I have sold out much too soon. But on the other hand, some of the stocks that I've bought into, which have done well, have obviously benefited from the liquidity that I've generated from those earlier sales. So, you can't have it both ways, really. I come back to my basic point that what we're trying to do is to make more correct decisions than incorrect decisions, have more gains than losses.
So your philosophy in the main is to hold, even if there's a profit warning, if it's not too dire. But what are your catalysts for selling? I'm sure you don't own all the shares that you've ever held.
Oh no! I think at one stage, looking back over my 60-year investing life, I think looking back through the old investment ledgers, I feel sometimes as if I've owned every share at some stage. So I've bought a lot and sold a lot. But certainly in recent years, I've become less and less active and more convinced that getting into something and staying aboard and holding it makes the most sense. And particularly, and you referred to this, with the size of holdings that I've got now, movement, selling is not easy anyway, as it were. So the answer is now, I rarely sell unless I'm really disillusioned with a particular company or with a particular chief executive, and do stay aboard for the long term. And as I indicated earlier, I've been on the receiving end of over 50 takeovers. So I'm of the view, say, taking the next 10 years, that probably half, maybe even 3/4 of the stocks that I'm in will actually be taken over. So sit there and wait.
So what creates the disillusionment? You've got something like Air Partners that had a bit of a scandal around their accounts, and they've now said that they'll have a half-2 weighting, but you're still as loyal as anything to them. What are the criteria that completely destroy your confidence?
Completely destroy the confidence if I was ever told anything by a company chief that turned out to be totally untrue, as it were. I mean, if it's just a judgment and people get a judgment wrong, or a company has a bad year, fair enough. I'm quite forgiving. But if it has 2 or 3 bad years, or if you feel the industry that it's in has gone totally ex-growth, as it were, then one moves on. I mean, if you go back, for the sake of argument, to the growth of supermarkets, in the early years there was huge opportunity if one had invested in supermarkets, and I was invested in one of the smaller supermarket company, I think called Amos Hinton, which was taken over subsequently by one, I think it may have been Tesco, who took it over. So one's seen a great growth in supermarkets, and now, of course, supermarkets are regarded as pretty well ex-growth, hugely competitive. Most have got stores where they want. You've had the Aldi's and the Lidl's coming in and cutting into the traditional supermarket operations, and so that really is an ex-growth area. And of course, so many areas of retailing are actually now ex-growth. We know so many retailers are having problems. Fortunately, I think I'm right in saying I'm not invested in any supermarket stocks, nor am I invested in any retail businesses. And then, of course, some of the property companies who own the who own properties on the high street or in the the out of town shopping centres. They're experiencing problems because of the problems of the retail sector. So there are clearly sectors that do go ex growth, and therefore, if I was in something that where it had become ex growth, then one would consider moving out. But as a generalisation, I tend to prefer to stay aboard if I'm still convinced.
And in the main, do you think it's an advantage to meet management or a disadvantage? Because they can pull the wool over your eyes and you can sort of fall in love with them and then feel a loyalty to them.
Well, first of all, I enjoy it. I enjoy meeting the people who are running the businesses that I invest in. I enjoy visiting the companies. I always have. I must have, over the years, in my business life and political life and investing life, visited hundreds and hundreds of shop floors and businesses, and I enjoy business and meeting those individuals. Overall, I believe meeting the individual, forming a view of them as sort of decent, trustworthy, balanced, sensible people is important. There is the other side. You can get a little bit too close to people, and people can let you down, and you feel a little bit of a heel, if you sell, as it were, if you've had a long-term relationship with some of those individuals. There can be a negative side to visiting companies and meeting management, but overall, it's far more advantageous. And so, just as an example, if one goes to see a new company, and when you're looking at a company and considering investing, you're actually trying to build a jigsaw on the company, where the profits record is a piece of the jigsaw, the dividend is a piece of the jigsaw, the balance sheet is the industry that they're in, the individuals running it, the people who are shareholders. I won't invest in businesses where the people running it haven't got a significant stake in that business. I do believe in having skin in the game. But to take an extreme example the other way, if one visits a new company and it's only small and only just making profits, and you see outside, parked just outside the main office there, the main reception, the latest, as an example, the latest bright red Ferrari, as it were, you think, well, maybe this is, not quite right. Isn't it a little bit early for our friend, the chief executive, to be investing in red Ferraris? Or similar, and you form a view of the individual. Do you want to put your money into that company and let the chief executive X be handling it? And once again, one can make mistakes. You get wool pulled over your eyes, but by and large, I don't think I've been let down in recent years, because if a chief executive or chairman is ridiculously over optimistic, and then they fail to deliver, then inevitably it backfires on them, as it were. So there's nothing to be gained in the longer term, by misleading. But I don't think I've been deliberately misled for a long time, thankfully.
And over your history of investing, you've met a lot of directors of companies. Do you feel that your judgment of them has, in the main, been correct?
I think yes. I like to think in the main it's been correct. Occasionally, one does get it wrong. I think that's inevitable. But by and large, I think meeting them is a plus. And what I try and impress upon them is that I'm not interested. I'm not trying to discover any inside information that I shouldn't have, as it were. What I'm interested in is where they see their business in 5-10 years' time, the broad strategy that they're adopting and following. So it's endeavouring to get aboard their long-term thinking rather than something that may happen with the next set of results.
And out of your holdings, who would you nominate top CEO at the moment?
Oh, the top CEO. Very, very difficult to say. Very difficult to say. But one that I do rate very highly, and there are a number, but one who I do rate very highly is Andrew Jacobs of Lock and Store, which is the self-storage, safe storage company that he has really built up from nothing. He's got a big stake in it, 20% or so himself. I think it's very tightly managed. It's being built up very sensibly, brick by brick, and it now represents quite a sizable holding as far as I'm concerned. I've probably so far sort of quadrupled my money on it, and Lock and Store and Andrew Jacobs tick a lot of boxes for me.
And what about a CFO?
I can't think of a particular CFO. I have to say I've always tended to focus on despite being an accountant myself, I've always tended to focus on the chief executive. But I've always also been very conscious that a good chief executive needs a first-class financial director as well. And it's normally the way the duo work that is important. Therefore, if I see a company having a number of different finance directors over the years, then you begin to think, well, either something's wrong with the business or something's wrong with the judgment or integrity of the chief executive. And it's rather like with our national economy, the real power in the UK government is the axis between the Prime Minister and the Chancellor of the Exchequer. And if that breaks down, as it has done on a number of occasions, then the government and the country do actually suffer. So having that duo is important. But at the end of the day, the key man has to be the chief executive.
So people reading your book may not feel they've got the confidence at this time to buy their first investment, and they may feel that funds are a safer way to go. What are your view on funds as against buying into individual companies?
Well, I think they may be safer in the sense that you inevitably are getting a spread of holdings, of underlying holdings in that particular fund. But you're paying fees, so fees are being taken from your worth, your value, and I don't think individuals get anything like the fun, the interest in the stock market through investing in funds, and I don't believe long term investing in funds will be as successful for people as investing in individual stocks or in a small number of stocks, provided they apply the disciplines that I've suggested they apply.
So if we've got one of the children that we've got in this book who have inherited their £2,500, what companies at the moment that you hold would you be very happy for them to be looking at?
Which individual companies? Well, I would have thought almost any of the companies that I'm at present invested in.
But some you've held for a long time,
yes.
So they're quite highly valued.
Yes.
So if they were your grandchildren, what would you be wanting to put their junior ISA into?
Well, there are a number of holdings that I'm in that at the moment I would say are pretty fully valued. Companies like Treat, for example. Companies like Lock and Store. But if you're looking 5 years ahead, 10 years ahead, they have very considerable growth ahead of them. So I wouldn't dissuade my grandchildren from investing in some of those that are now highly valued, where I've made a lot of money on paper anyway. There are a number of my other holdings that I'm adding to now with the proceeds of my very recent takeover of Tarsus, which was my second biggest holding, second to Treat. So that will produce a lot of liquidity. And my big debate within myself is how do I deploy that money? Do I focus, given my age, a little bit more on stocks that are yielding rather more, or do I focus rather more on the types of companies that I have been invested in over the years? And that is the way I'm actually moving. And so what I've tended to do so far with some of the monies that have come through from Tarsus, from the takeover, is to add to some of the holdings that I've got. So I've been adding to Air Partner, I've been adding to Christie, I've been adding to MP Evans, I've been adding to Vitec, companies like that. And also maybe putting my toe into one or two newer ones, like PhotoMe, for example, and Hanstein, the property company that is almost entirely invested in industrial estates and industrial buildings rather than either office buildings or retail properties.
So PhotoMe, you believe in the new laundry products going forward, even though the photo market is deteriorating?
The traditional photo booths are deteriorating. The laundry side seems to be growing. But what I thought was particularly interesting was the last acquisition that they made, which was of a leading French company in the vending of fruit juices. And with their expertise, technical expertise, and marketing awareness and international spread, they're planning to roll out the fruit juice vending operation across their wider territories, which I think does offer very interesting possibilities for growth. And also I was able to pick PhotoMe up after the last results on a yield of about 9.5%, which was quite attractive. They've actually gone up about 10% since I bought. So it's slightly more speculative than I normally buy, but I think I can afford to take one or two risks from time to time,
And where do your ideas come onto your radar? Is it on morning RNSs, or do you screen for stocks?
I obviously read a lot of city columns and investment publications. So, one's looking at companies, one's assessing them. I mean, I like to think that companies that have been around some years, I'm aware of them, because obviously over the years one's built up a really big library in one's own head, as it were, of companies and their history. On the other hand, there are a lot of new AIM companies that it's just impossible to really learn about. So I'm sure I lose out a little bit in that area. And then I'm a member of two or three a breakfast investment group and a luncheon investment group and a dinner investment group, small groups of people who get round the table and enjoy the meal. I have to say, glad to say they all don't come on the same day, and swap ideas, and in some cases we have little competitions as well. And then one also attends presentations and conferences, investment conferences like Mello, for example, for private investors, where one hears chief executives, deliver and talk about their companies. So ideas come from a range, from the written form, from gossip, and from listening as well.
And where did PhotoMe come from?
PhotoMe, I think, I've been aware of PhotoMe for many, many years as a company. There was always a bit of a question mark over it, and indeed there still is. But I read the later results, I think, in the Investors Chronicle, and thought I'd have and became aware of this last acquisition they'd made, and decided that I'd put my toe in the water and invest there, and then was quite pleased to see that the chief executive had bought another couple of £100,000 worth of shares or similar, a couple of weeks later. So that gave me encouragement, although he's got a very large holding himself anyway. So but once again, that is something that I like to see people who are running the businesses really committing their savings to that business.
When you were doing your research for the book and from your own children, what did you feel was the main catalyst for young people getting interested in investing?
The main catalyst. It's difficult to say what the main catalyst would be, but I suppose young people clearly they think about their careers, they think about marriage, they think about maybe setting up a home, maybe being in a position to buy a house, as it were. So therefore, what are they going to do with their savings while they're saving for a deposit? So if they think about the stock market, then I would encourage them to make modest investments and try to build up their capital, and also appreciate the dividend income flow that comes from investing.
And do you think your grandchildren will take on their grandfather's mantle?
Well, I've said in the book, I've actually dedicated this book to my 4 grandchildren, and I've said, I just hope that at least one of them shares my enthusiasm for the stock market. But there's a long way to go. The youngest is 1. The eldest is nearly 6. So I don't need to worry too much. But it would be very nice if in years to come, at least one of them was to take a real interest. And I have two daughters. They have quite sizable share portfolios themselves, but I've not been able to interest them, I have to be honest, in the stock market. And part of the reason for the book is to enable my daughters, as it were, to build up a certain amount of knowledge which will enable them in years to come to take the decisions or to understand why people are taking decisions when I'm no longer there.
Tremendous. Remind us again where people can buy the book and who they might buy it for.
Well, it's available on Amazon. It's available through pretty well all bookshops. And I think it's the sort of book that youngsters may not necessarily want to buy themselves, but I think it's a book that grandparents, godparents, parents might buy, particularly as, say, a Christmas present for their offspring, to interest them in the stock market, to make them aware of how it works, and also, of course, that potentially there is, I think, quite a big schools audience for economic students and others, particularly as we do want to and need to encourage more schools and similar to teach the basics of finance and investment to pupils.
Lord Lee, many thanks indeed for your time.
My pleasure. Thank you.